Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ingredion Incorporated annual report. Ingredion Incorporated offers a diverse range of businesses and services across various industries worldwide. The company's product portfolio includes starch products for processed foods, specialty paper starches, and industrial starches used in construction materials, textiles, adhesives, pharmaceuticals, cosmetics, mining, and water filtration. In addition to starch products, Ingredion also provides sweetener solutions comprising glucose syrups, high maltose syrup, high fructose corn syrup, dextrose, polyols, maltodextrin, glucose syrup solids, and non-genetically modified organism syrups. These sweeteners are used in various food and beverage applications such as baked goods, snack foods, dairy products, ice cream, jams and jellies, prepared mixes, table syrups, and beverages. The company also offers refined corn oil, corn gluten feed, and corn gluten meal, as well as other products. Ingredion's biomaterial solutions include biodegradable plastics, fabric softeners and detergents, hair and skin care applications, dusting powders for surgical gloves, and the production of glass fiber and insulation. Overall, Ingredion Incorporated provides a comprehensive range of businesses and services across various industries, including food and beverage, industrial, and biomaterials. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any publicly traded company can fluctuate due to various market and economic factors. One possible reason for a decline in Ingredion Inc.'s stock price is a decrease in demand for its products or services. This could be due to changes in consumer preferences, increased competition from other companies, or a shift towards alternative ingredients. Another factor that might contribute to a drop in stock price is a decline in the company's financial performance. This could include lower revenue, reduced profitability, or decreased cash flow. If investors lose confidence in the company's ability to generate returns, they may sell their shares, causing the stock price to fall. Additionally, external market factors such as changes in interest rates, economic downturns, or global events can also impact a company's stock price. For example, if there is an increase in borrowing costs due to higher interest rates, companies with high debt levels may struggle to service their debts, leading to a decline in their stock prices. In the food and beverage industry, regulatory changes or concerns about food safety and sustainability can also affect a company's stock price. If consumers become increasingly concerned about the environmental impact of food production or the use of certain ingredients, companies that are perceived as being out of touch with these trends may see their stock prices decline. It is worth noting that Ingredion Inc.'s stock price may have been affected by a combination of these factors, and it would be necessary to examine more specific data and information to determine the exact reasons for its decline. Ingredion Incorporated market capitalization of $7 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Ingredion Incorporated holds a significant advantage in their industry. Ingredion Incorporated trades at a lower price-to-earnings ratio of 10 times and a higher price-to-book ratio of 1.71 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.83%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On one hand, stable revenue streams such as starches and sweeteners contribute significantly to the company's net sales, remaining relatively stable from 2023 to 2025. On the other hand, certain segments have experienced revenue growth due to various drivers. The Texture and Healthful Solutions (T&HS) segment has seen higher average selling prices, increased customer value, and growing market trends in health and wellness, clean label, and other areas. Additionally, the Food and Industrial Ingredients (LATAM) segment has benefited from local sourcing of raw materials, fee-based contracts with pricing updates, and firm-priced contracts in Mexico. However, some segments have experienced revenue decline due to various factors. The F&II US/Canada segment has seen lower volumes from the beverage and food industries, as well as a lower price mix. Similarly, the Food and Industrial Ingredients (LATAM) segment has faced lower volume demand, while the All Other segment has lost volumes from the sale of South Korea business. Other drivers that have impacted revenue growth or decline include commodity prices, foreign currency exchange rates, interest rates, hedging activities, and changes in consumer practices, preferences, price sensitivity, behaviors, demand, and perceptions. Furthermore, growing concerns about obesity and inactive lifestyles may also affect demand for certain food products containing biotechnology-derived ingredients. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased from 2023 to 2024, but then increased by $82 million, a 12.6% rise. However, this trend was short-lived, as net income dropped by $81 million in 2025. A notable exception occurred in 2025, when the PureCircle acquisition contributed an additional $7 million to the company's net income. The profit margins of the company also experienced changes during this period. The gross profit margin increased from 21.5% in 2023 to 24.2% in 2024, but then decreased slightly. Similarly, the operating income margin rose from 11.7% in 2023 to 11.9% in 2024 before declining. The reasons behind these changes were multifaceted. Net income fluctuations were influenced by various factors such as the sale of the South Korea business and impairment charges. Profit margins, on the other hand, were affected by fluctuations in raw material prices, energy costs, and hedging activities. These external factors contributed to the company's changing financial performance over the 3-year period. The financial health of a company can be gauged by its ability to generate positive operating cash flow. However, the latest data from the company's financial documents suggests mixed results. In 2024 and 2023, the company had positive operating cash flows of $1,436 million and $1,057 million, respectively. However, in 2025, the trend seems to have reversed with a negative operating cash flow of $944 million reported on pages 28 and 48. Furthermore, page 52 explicitly states that there is no positive operating cash flow. This information raises concerns about the company's ability to generate sufficient cash from its core operations. The uncertainty surrounding the company's financial health is further highlighted by the lack of clarity in page 98, which fails to provide a clear indication of whether the company is generating positive operating cash flow or not. Based on the available data, it appears that the company may be struggling to maintain a positive operating cash flow in 2025. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt outstanding has remained at $1.8 billion in both 2024 and 2025, indicating no change in this metric. However, a closer look reveals that the total net debt decreased from $823 million in 2024 to $757 million in 2025, suggesting a slight decrease. In terms of interest expenses, there is a clear indication of a decrease. The interest expense on average outstanding debt balances was lower in 2025 compared to 2024, contributing to a decrease in financing costs. Furthermore, the implied interest expense ratio was also lower in 2025 compared to 2024. Additionally, the interest expenses, financing costs, decreased from $39 million in 2024 to $37 million in 2025. Overall, while the company's debt level has remained relatively stable or decreased slightly, the decrease in interest expenses is a notable change. This suggests that the company has been able to manage its debt effectively and reduce its financing costs, which can have a positive impact on its bottom line. The company's performance varied across different segments and regions. The Texture and Healthful Solutions (T&HS) segment stood out as a top performer, achieving higher average selling prices and favored volumes. This segment also had a strong global presence with own facilities in various countries. In contrast, the Food and Industrial Ingredients LATAM segment struggled due to intense competition from U.S. imports into Mexico and local producers, resulting in lower volume sales. The F&II segment, which likely refers to food and industrial ingredients, performed relatively well, but did not have any explicit information on poor performance. The company's global presence was also evident in the All Other segment, with own facilities in China, Malaysia, Pakistan, and the U.S. However, it is worth noting that the Food and Industrial Ingredients US/Canada segment also had a strong presence with own facilities in Canada and the U.S., but its performance was not explicitly mentioned as poor or well-performing. Management is focused on delivering high-performance ingredients through innovation and efficiency. They aim to drive sustainable growth by investing in research and development, while also attracting and retaining global talent. The company's strategy is centered around providing healthy solutions through the optimization of global operations and reduction of corn costs. In terms of financial performance, management targets an adjusted return on invested capital (ROIC) of over 10% and a net debt to adjusted EBITDA ratio of 2.5 or less. They also aim to maintain internal control over financial reporting and ensure sufficient liquidity to fund capital expenditures and dividends. The company's manufacturing facilities are expected to meet current production commitments, with ongoing capital investments for updates and improvements. However, management notes that they may need to raise additional capital for less predictable initiatives. Additionally, the company is focused on managing its risks, including those related to changes in consumer preferences, price sensitivity, national economic conditions, and geopolitical developments. Overall, management strategy is centered around delivering sustainable growth through innovation and efficiency, while also ensuring financial stability and risk management. The company has made several strategic moves through acquisitions and divestitures in recent times. On the acquisition front, two notable deals stand out. Firstly, the company formed a joint venture with Agrana, details of which can be found on page 53. Secondly, it acquired shares from minority shareholders as part of its PureCircle acquisition, as mentioned on page 54. In terms of divestitures, the company has been actively selling off non-core businesses to focus on core operations. One such deal is the sale of an interest in the Pakistan business, which is still pending agreement and can be found on page 15. The company has also sold its 51% ownership interest in Rafin Maize Products Co. Limited, a Pakistani business, as mentioned on page 54. Furthermore, the company has divested its South Korea business to an affiliate of the Sajo Group, with details available on page 54. Interestingly, this sale is not the only one involving the South Korean market, as the company also sold its South Korean business without specifying the amount involved, which can be found on page 73. These strategic moves demonstrate the company's efforts to optimize its portfolio and focus on high-growth areas. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends, which is a distribution of profits to shareholders. The company's financial reports confirm that it has indeed paid dividends on multiple occasions, as mentioned in pages 19, 24, 28, 48, and 100. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. This means that the company has purchased a portion of its own shares from the market, thereby reducing the number of outstanding shares and increasing the value of each remaining share. The financial reports indicate that the company has engaged in share buybacks on several occasions, as noted in pages 19, 24, 28, 48, and 84. Concerns about inventory buildup and supply chain disruption are evident in various aspects of a company's operations. Inventory buildup is a concern due to factors such as quarterly pricing updates for brewing industry contracts, which may lead to overproduction and increased inventory carrying costs. Additionally, volatile economic conditions can cause companies to hold onto inventory longer, resulting in decreased cash flow. Furthermore, the sufficiency of audit evidence over raw materials and finished goods inventory has been questioned, highlighting a critical issue that needs attention. On the other hand, supply chain disruptions are a significant concern due to geopolitical tensions, manufacturing facility difficulties, crop diseases, severe weather conditions, fluctuations in energy costs, and pandemics. These factors can impact business operations, leading to shortages of products and affecting demand satisfaction. The potential for inventory buildup and supply chain disruption is a pressing issue that requires careful management and mitigation strategies. Companies must be prepared to adapt to changing market conditions and take proactive steps to minimize the risks associated with these concerns. That concludes the financial summary for Ingredion Incorporated. Feel free to comment below, and I will be happy to answer them when possible.